Every year, every single year, the moment April ends, someone on the financial Twitter, someone on a trading forum, someone at a dinner table says it. Sell in May and go away. And millions of investors actually listen to it. But here is my question. Has anyone actually stopped to check if this still holds true? Or are we just repeating a phrase that was born in a completely different world, in a completely different century, and applying it to your money? Is this advice actually protecting your wealth? Or is it the reason you're missing out on the biggest rallies of the year? Let us look at the numbers. First, where did this even come from? The full saying is sell in May and go away. Come back on St. Leger's Day, a horse racing event in England in the 1700s. You heard that right. London's wealthy traders and bankers would literally leave the city for the summer, off to the countryside, off to the races, and return in the month of September when the social and financial season resumed. That is it. That's the whole theory. The market slowed down because the people running the market went on a holiday. Now ask yourself, does that sound like the world we live today? Where algorithms trade 24 hours, where New York, Mumbai, Tokyo, and London are connected in milliseconds, where your phone gives you a market update before you have had your morning chai. But I will show you why staying in could be the most profitable decision you make this summer. Now, here is where I'll give the concept its due credit. Because data doesn't care about our opinions. In the United States, over the last 70 years, the S&P 500 has averaged significantly stronger returns from November through April compared to May through October. November to April, historically stronger. May to October, historically weaker. The pattern definitely exists. I won't deny that. But let me show you what that pattern hides. In 2020, the world was in lockdown. So, by conventional wisdom, sell in May, stay away. But what happened? Instead, the S&P 500 rallied nearly 40% between May and August alone. One of the greatest recoveries in the modern market history. In 2023, markets were supposed to be fragile. May came and went, and the S&P 500 continued its march higher through the summer. The pattern works until the 1 year it doesn't. And that 1 year can wipe out a decade of following the rule. But wait, before you think this is just a US problem, let us look at what happened right here in Mumbai during the same period. Now, let us talk about Indian markets, BSE SENSEX, Nifty 50. Because the India story is very different. And here is a number that might surprise you. Nifty 50 has actually closed in the green in the 4 of the last 5 Junes. 4 out of 5. Think about how many investors sat out those months because of a British horse race. India does not run on London's summer calendar. We run on the monsoon, on the union budget, RBI policy cycles, on earnings, on GST collections that tell a completely different story about our economy every single month. While the US may see a summer dip driven by lower Western participation, India's own calendar is packed with market moving events right through May to October. Every single one of them a potential catalyst. The 2020 post lockdown recovery happened right through the go away months. The 2023 mid year surge, same story. Foreign institutional investors may take summer vacations, but domestic investors, whether it can be retail, mutual funds, SIPs, they don't. India has a buying habit now, a structural, monthly, systemic buying habit. And that habit doesn't check the calendar. So, why does the pattern sometimes hold? Here is the real answer. It is not seasonal magic, it is liquidity. Summer, in the best means, the big banks and the hedge funds are doing fewer trades. So, lower volumes, thinner markets, and thinner markets amplify moves both up and down. When big money steps back, even small selling pressure can move markets more than usual. That is not a seasonal phenomenon. That's a basic market mechanics. And here is the deeper irony. The more people believe in sell in May, the more they sell in May, which creates the very weakness they were predicting. It becomes a self-fulfilling prophecy, not a market truth. So where does that leave us? Don't dismiss the concept entirely. Seasonal patterns are worth knowing, but don't hand your portfolio over to a calendar proverb either. So the question is, what tells you more than any month name ever good? Well, the answer is India VIX, put call ratio, price structure, options open interest, real data, live data, the kind that reflects what the market is actually pricing in, not what a 300-year-old horse racing tradition suggests. The market doesn't know what month it is. It only knows price. And you should too. I am S. Kamal Kumar. This is Philbert. Stay informed. Stay disciplined. If you like this video, do not forget to comment, subscribe, and like. And also, I made a free course for equity analysis. The link is in the description. Do click it. Thank you.